Here's the big voice, Marc Faber, editor and publisher of the Gloom, Boom and Doom report. Let's welcome him on the show. Marc, hi, good morning. Good to chat with you. Indian markets currently at record highs. Would you say the time has come to turn cautious, or would you think the ride has just about started?
The emerging markets that had underperformed the US meaningfully since 2011. And so it's a very mixed bag. The European markets, by and large, certainly in US dollar terms, are not at the new highs. And even India, after its very good performance so far this year, and India has grossly outperformed the US this year, is in dollar terms still lower than at its peak a few years ago. So we have to be very careful. I think some markets will continue to go up, and I think other markets will go down. And within markets, there will be some stocks that will go up, and other stocks are probably extremely expensive and extended and will go down.
So, Marc, do you think India will outperform other emerging markets? What is your view there?
Well, I think already a year ago, I mentioned that if I had to invest money for 5 or 10 years, my belief was that India would outperform the US, because the US is a highly prized market. It's now 54% of global market capitalization, and that India had a relatively to the US low valuation, and that it would outperform the US for many years. So yes, I would essentially say my view has been already for 18 months or so that you will make more money in emerging markets. And last year, some emerging markets in Asia significantly outperformed the US. We were up between 15 and 25% in Indonesia, the Philippines, Thailand, Vietnam, and the US hardly moved up. This year, so far this year, despite all this hoopla-hoop about the US market, the European markets, most of them have outperformed the S&P, and emerging markets, practically every emerging market has outperformed the US.
Right. So would you continue to buy India, Marc, even at these current levels?
Well, I think that international investors, and I have to point out that recently PwC published a study about the long-term outlook of the global economy and about the ongoing shift in the balance of economic power in the world, which essentially showed very clearly how some countries had become very important economic powers over the last 20 to 30 years, including China and Vietnam and also India to some extent. But basically that study concluded that by year 2050, India would be purchasing power adjusted the third largest economy or the second largest economy. And I think if you look at what has happened in Europe and the US, where despite all the fiscal stimulus and money printing, you have essentially very anemic growth. And you look at China, where you have, say, around 6-7% growth, and India maybe over 7%, who knows? Then you have to say over the long term, if you can grow, even if it's in India just 5%, but 5% in the global economy is a very rapid growth rate compared to Europe and the US. And so I would, as an investor, as I said, for the next 10 years, 5 years, 20 years, I would find ways to invest in India and in emerging markets in general. The emerging market that is going to grow probably the most is Vietnam, and Indochina, Cambodia, Laos, Myanmar. But I mean, the outlook for India, and the proviso is, of course, peace in the world, that we don't get into a major military confrontation. But if we have peace, and in absence of a huge natural disaster like a pandemic, then I think the outlook for the Chinese economy, for the Indian economy, for emerging markets in general, is far superior to the outlook in our rotten Western democracies.
So Mark, ultimately what our viewers they want to know is that how should one put money to work in India? What would you like to buy in India?
Yes, I mean, in an economy that expands at 5% per annum or more, there are plenty of opportunities. I maintained for a long time that, and I'm not the manager of the India Capital Fund, it's managed by investment managers. I'm just the chairman of the company, and I have nothing to do essentially with the investment process. But basically, they were overweight banks, and I still think that they are overweight banks. And they find companies that can grow significantly and are reasonably valued. So I think there are plenty of opportunities. The other opportunity that I believe is unfolding is obviously domestic and international tourism. And that brings about huge potential for all kinds of hotel chains. And of course, over time, like in Europe and the US, people will have second homes. In other words, if you can move people around efficiently, then people will go out of the cities for their weekends and for their holidays. And so people will live maybe in Mumbai, but then have a weekend home somewhere on the beach and travel there quite frequently. So I think there is still a huge opportunity in real estate.
Okay. So is China's loss for India a gain for commodities? Where would you say we are in the cycle right now, especially given the near-term rebound that one has seen?
Well, my sense is this. We had a huge bull market in commodities between 1999 and in some cases 2008. For oil, it peaked out at $147 in July 2008. And for other commodities, they continued to go up until 2011. And then commodities, by and large, declined sharply until the end of 2015, early 2016, when oil briefly went towards $30. And subsequently, we had a strong rebound in commodity prices, principally because the demand from China stabilized and started to increase again. And so that drove some commodities up. Plus, in some cases, there is the expectation that the shift to electric cars will increase the demand for copper very substantially, as well as the increased defense expenditures. And so each commodity has to be looked individually. And some have rebounded and some have gone up dramatically, like zinc last year was up over 80%. And others are still relatively depressed. I think that agricultural commodities are relatively depressed, although the price of sugar last year doubled also. So each commodity has to be analyzed separately. But one thing I can say, we are in a world where central banks in the advanced economies, Japan, the US, Europe, have printed money. And I have to applaud there Mr. Rajan, your former Reserve Bank of India governor, for having resisted printing money. he stabilized the Indian rupee, which is for India far more important than money printing and the stock market going up. So the Reserve Bank of India has pursued a very good policy. But the other central banks in the Western world are basically money printers. And they will continue to print money. If the economy weakens, they'll go into the US QE4, and the Europeans the same, and the Bank of Japan the same. So regardless whether the global economy picks up or not, I believe that commodity prices are at a relatively low level. And I would rather invest in commodity-related plays than in, say, financial assets and in companies that are valued at infinity because they have no earnings.
Okay, Marc, great speaking with you. Thanks so much for taking the time out.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.